a business can use a variety of pricing strategies when selling a product or service. The price can be set to maximize profitability for each unit sold or from the market overall. It can be used to defend an existing market from new entrants, to increase market share within a market, or to enter a new market. Businesses may benefit from lowering or raising prices, depending on the needs and behaviors of customers and clients in the particular market. Finding the right pricing strategy is an important element in running a successful business. Models of pricing: absorption pricing, types of pricing in which all costs are recovered. The price of the product includes the variable cost of each item plus a proportionate amount of the fixed costs and is a form of cost-plus pricing. Contribution margin-based pricing. Contribution margin-based pricing maximizes the profit derived from an individual product, based on the difference between the product's price and variable costs, and on unregistered trademark S assumptions regarding the relationship between the product unregistered trademark S price and the number of units that can be sold at that price. The product's contribution to total firm profit is maximized when a price is chosen that maximizes the following: X. In cost-plus pricing, a company first determines its break-even price for the product. This is done by calculating all the costs involved in the production, marketing and distribution of the product. Then a markup is set for each unit, based on the profit the company needs to make, its sales objectives and the price it believes customers will pay. For example, if the company needs a 15% profit margin and the break-even price is $2.59, the price will be set at $2.98. Creaming or skimming: in most skimming, goods are sold at higher prices so that fewer sales are needed to break even. Selling a product at a high price, sacrificing high sales to gain a high profit is therefore skimming the market. Skimming is usually employed to reimburse the cost of investment of the original research into the product, commonly used in electronic markets when a new range, such as DVD players, are firstly dispatched into the market at a high price. This strategy is often used to target early adopters of a product or service. Early adopters generally have a relatively lower price sensitivity. This can be attributed to their need for the product outweighing their need to economize, a greater understanding of the product's value, or simply having a higher disposable income. This strategy is employed only for a limited duration to recover most of the investment made to build a product. To gain further market share, a seller must use other pricing tactics such as economy or penetration. This method can have some setbacks as it could leave the product at a high price against the competition. Decoy pricing, method of pricing where the seller offers at least 3 products, and where 2 of them have a similar or equal price. The 2 products with the similar prices should be the most expensive ones, and one of the 2 should be less attractive than the other. This strategy will make people compare the options with similar prices, and as a result sales of the most attractive choice will increase. Freemium. Freemium is a business model that works by offering a product or service free of charge while charging a premium for advanced features, functionality, or related products and services. The word freemium is a portmanteau combining the 2 aspects of the business model, free and premium. It has become a highly popular model, with notable success. High-low pricing, method of pricing for an organization where the goods or services offered by the organization are regularly priced higher than competitors, but through promotions, advertisements, and/or coupons, lower prices are offered on key items. The lower promotional prices are designed to bring customers to the organization where the customer is offered the promotional product as well as the regular higher-priced products. Limit pricing. A limit price is the price set by a monopolist to discourage economic entry into a market, and is illegal in many countries. The limit price is the price that the entrant would face upon entering as long as the incumbent firm did not decrease output. The limit price is often lower than the average cost of production or just low enough to make entering not profitable. The quantity produced by the incumbent firm to act as a deterrent to entry is usually larger than would be optimal for a monopolist, but might still produce higher economic profits than would be earned under perfect competition. The problem with limit pricing as a strategy is that once the entrant has entered the market, the quantity used as a threat to deter entry is no longer the incumbent firm's best response. This means that for limit pricing to be an effective deterrent to entry, the threat must in some way be made credible. A way to achieve this is for the incumbent firm to constrain itself to produce a certain quantity whether entry occurs or not. An example of this would be if the firm signed a union contract to employ a certain level of labor for a long period of time. In this strategy, price of the product becomes the limit according to budget. Loss leader. A loss leader or leader is a product sold at a low price to stimulate other profitable sales. This would help the companies to expand its market share as a whole. Marginal cost pricing. In business, the practice of setting the price of a product to equal the extra cost of producing an extra unit of output. But this policy, a producer charges, for each product unit sold, only the addition to total cost resulting from materials and direct labor. Businesses often set prices close to marginal cost during periods of poor sales. If, for example, an item has a marginal cost of $1 and a normal selling price is $2, the firm selling the item might wish to lower the price to $1.10 if demand has waned. The business would choose this approach because the incremental profit of 10 cents from the transaction is better than no sale at all. Market-oriented pricing, setting a price based upon analysis and research compiled from the target market. This means that marketers will set prices depending on the results from the research. For instance, if the competitors are pricing their products at a lower price, then it's up to them to either price their goods at an above price or below, depending on what the company wants to achieve. Odd pricing. In this type of pricing, the seller tends to fix a price whose last digits are odd numbers. This is done so as to give the buyer's consumers no gap for bargaining, as the prices seem to be less and yet in an actual sense are too high, and takes advantage of human psychology. A good example of this can be noticed in most supermarkets, where instead of pricing at $10, it would be written as $9.99. This pricing policy is common in economies using the free market policy. Pay what you want. Pay what you want is a pricing system where buyers pay any desired amount for a given commodity, sometimes including zero. In some cases, a minimum price may be set, and/or a suggested price may be indicated as guidance for the buyer. The buyer can also select an amount higher than the standard price for the commodity. Giving buyers the freedom to pay what they want may seem to not make much sense for a seller, but in some situations it can be very successful. While most uses of pay what you want have been at the margins of the economy, or for special promotions, there are emerging efforts to expand its utility to broader and more regular use. Penetration pricing. Penetration pricing includes setting the price low with the goals of attracting customers and gaining market share. The price will be raised later once this market share is gained. Predatory pricing. Predatory pricing, also known as aggressive pricing, intended to drive out competitors from the market. It is illegal in some countries. Premium decoy pricing, method of pricing where an organization artificially sets one product price high, in order to boost sales of a lower-priced product. Premium pricing. Premium pricing is the practice of keeping the price of a product or service artificially high in order to encourage favorable perceptions among buyers, based solely on the price. The practice is intended to exploit the tendency for buyers to assume that expensive items enjoy an exceptional reputation, are more reliable or desirable, or represent exceptional quality and distinction. Price discrimination. Price discrimination is the practice of setting a different price for the same product in different segments to the market. For example, this can be for different classes, such as ages, or for different opening times. Price leadership. An observation made of oligopolistic business behavior in which one company, usually the dominant competitor among several, leads the way in determining prices, the others soon following. The context is a state of limited competition, in which a market is shared by a small number of producers or sellers. Psychological pricing. Pricing designed to have a positive psychological impact. For example, selling a product at $3.95 or $3.99, rather than $4. There are certain price points where people are willing to buy a product. If the price of a product is $100 and the company prices it as $99, then it is called psychological pricing. In most of the consumer's mind, $99 is psychologically a euro less, a euro unregistered trademark, than $100. A minor distinction in pricing can make a big difference in sales. The company that succeeds in finding psychological price points can improve sales and maximize revenue. Target pricing method whereby the selling price of a product is calculated to produce a particular rate of return on investment for a specific volume of production. The target pricing method is used most often by public utilities, like electric and gas companies, and companies whose capital investment is high, like automobile manufacturers. Target pricing is not useful for companies whose capital investment is low because, according to this formula, the selling price will be understated. Also, the target pricing method is not keyed to the demand for the product, and if the entire volume is not sold, a company might sustain an overall budgetary loss on the product. Time-based pricing. A flexible pricing mechanism made possible by advances in information technology, and employed mostly by Internet-based companies. By responding to market fluctuations or large amounts of data gathered from customers, ranging from where they live to what they buy to how much they have spent on past purchases, dynamic pricing allows online companies to adjust the prices of identical goods to correspond to a customary euro unregistered trademark's willingness to pay. The airline industry is often cited as a dynamic pricing success story. In fact, it employs the technique so artfully that most of the passengers on any given airplane have paid different ticket prices for the same flight. Value-based pricing. Pricing a product based on the value the product has for the customer and not on its costs of production or any other factor. This pricing strategy is frequently used where the value to the customer is many times the cost of producing the item or service. For instance, the cost of producing a software CD is about the same independent of the software on it, but the prices vary with the perceived value the customers are expected to have. The perceived value will depend on the alternatives open to the customer. In business, these alternatives are using competitors' software, using a manual workaround, or not doing an activity. In order to employ value-based pricing, you have to know your customer's business, his business costs, and his perceived alternatives. It is also known as perceived value pricing. Other pricing approaches, other pricing strategies include yield management, congestion pricing and variable pricing. 9 Laws of Price Sensitivity and Consumer Psychology. In their book, The Strategy and Tactics of Pricing, Thomas Nagel and Reed Holden outline 9 laws, or factors that influence how a consumer perceives a given price and how price-sensitive they are likely to be with respect to different purchase decisions. They are: reference price effect, a euro buyer, a euro unregistered trademark's price sensitivity for a given product increases the higher the product, a euro unregistered trademark's price relative to perceived alternatives. Perceived alternatives can vary by buyer segment, by occasion, and other factors. Difficult comparison effect, a euro buyers are less sensitive to the price of a known or more reputable product when they have difficulty comparing it to potential alternatives. Switching costs effect, a euro the higher the product-specific investment a buyer must make to switch suppliers, the less price-sensitive that buyer is when choosing between alternatives. Price quality effect, a euro buyers are less sensitive to price the more that higher prices signal higher quality. Products for which this effect is particularly relevant include image products, exclusive products, and products with minimal cues for quality. Expenditure effect, a euro buyers are more price-sensitive when the expense accounts for a large percentage of buyers, a euro unregistered trademark available income or budget. End benefit effect, a euro the effect refers to the relationship a given purchase has to a larger overall benefit, and is divided into 2 parts: derived demand. The more sensitive buyers are to the price of the end benefit, the more sensitive they will be to the prices of those products that contribute to that benefit. Price proportion cost. The price proportion cost refers to the percent of the total cost of the end benefit accounted for by a given component that helps to produce the end benefit. The smaller the given component's share of the total cost of the end benefit, the less sensitive buyers will be to the component's price. Shared cost effect Euro The smaller the portion of the purchase price buyers must pay for themselves, the less price sensitive they will be. Fairness effect Euro Buyers are more sensitive to the price of a product when the price is outside the range they perceive as a Euro or fair a Euro or a Euro or reasonably a Euro given the purchase context. The framing effect Euro Buyers are more price sensitive when they perceive the price as a loss rather than a foregone gain, and they have greater price sensitivity when the price is paid separately rather than as part of a bundle. References